30,000. But let's take the discussion forward with Pranav Gundlapalle, Senior Research Analyst at Sanford Bernstein, who's joining us. Pranav, morning. Thank you very much for your time. Before I talk about HDFC Bank, the entire private banking space, a quick word on this bond inclusion and what it could do, the money market and the flows. What are your thoughts? How meaningful could it be for interest rate environment as well here in India?
See, I think this whole bond inclusion would be a bigger factor for the liquidity environment. I think this has been one of the events that potentially the central bank was waiting for before easing liquidity, because they didn't want to ease before seeing the impact of these flows coming in. So I think from a liquidity perspective, this would be a positive, and which has been one of the biggest overhang on the banking sector. So an easing of that would definitely be a positive for the banks.
Pranav, let's talk about the private banking space then. On the one hand, it has been doing phenomenally well. If you talk of pure growth in the top 5 names, the way they've managed their NIMs as well as asset quality, I mean, phenomenal work done by some of them. But they've been on the receiving end of the outflows from FIIs. How do you think things would change from here on? We've got 2 blowout days by the entire private banking space in the last one fortnight or so. Is it a sign that things are changing?
See, I think on the operational metrics, the private sector banks have, like you said, have done phenomenally well. And even from here, we do expect them to outperform the public sector banks, both in terms of the EPS growth numbers or even the fundamental metrics as well. I think what hasn't helped them from a stock price perspective has been the foreign outflows. And given the high ownership in the private sector banks, I think they've naturally been at the receiving end. So I think with inflows potentially coming back, I think they would stand to benefit the most. I think from a foreign investor perspective, the private sector banks remain the favorites. So any inflows from there should benefit them more than the public sector banks.
You know, Pranav, the debate in the market is whether on ground things are actually looking up for the private banking space, or is the market just looking at it as a valuation play because some of these have not gone anywhere in the past year and a half?
See, I think a couple of things here. For the public sector banks, 2 things have really worked over the last 2 years, right? So one was that you had this nice asset quality improvement, or rather the credit cost declines, which brought their profitability quite, at least on an ROE perspective, quite comparable to that of the private sector banks. I think that's one thing. And the second is, a couple of years ago, they were sitting with significant amount of excess liquidity. And therefore, even on the growth front, despite their deposit growth trailing the private sector banks, they've been able to deliver loan growth, which is almost on par with their private sector banking peers. Now, I think that is kind of run its course. Where we are looking at today is both on the profitability and the growth front, we expect a greater divergence from here. So we have, for example, on the deposit side, the public sector banks are still growing at about 10% compared to about 17% for the private sector banks. Once you have that and there is no excess liquidity, then you will naturally see a growth outperformance from the private sector banks. On the profitability too, we have a scenario where credit costs are expected to normalize. And that, for example, a 30 bips increase in credit cost across the board will hit the public sector banks much harder from an ROA perspective. And that again will lead to an EPS growth divergence. So overall, we believe that the outperformance will look even more stark for the private sector banks, and that should lead an outperformance from a stock perspective as well.
In light of this view on the private banks versus what you expect from the PSBs, Pranav, also highlight why this bull case for HDFC Bank, wherein you believe that in the next 4 years, it's going to return to industry-leading profitability and parameters.
Right. See, I think what is now well understood is the few factors that have led to a lower ROA for HDFC versus its peers. And most of these are one-off or because of deliberate actions from the bank. And as those reverse or normalize, we do expect the profitability to improve. The 3 key factors here are 1, loan mix improvement for HDFC. The bank has seen a shift towards lower yielding corporate segments, and therefore they have developed a significant gap in yields versus peers. Now, as that normalizes, we do expect an improvement in their loan yields versus their peers. The second is, of course, the well understood increase in cost of funds because of the merger with HDFC Limited. Now, as long as the bank is able to deliver deposit growth of about 18 to 20%, which means that they maintain their incremental market share of around 16% in the industry, they should be able to normalize their liability franchise, which is their LDRs come down to less than 91% in a 3-year time frame, and that will again lead to a significant improvement in ROA. So the last one would be an operating leverage. Now, the combined entity used to have an OPEX to assets ratio or operating cost to assets ratio of about 1.7, versus today they are at about 1.85, 1.9%, simply because of the aggressive branch expansion. Now, once that starts to moderate, that again becomes ROA accretive. So this is a unique story in the sector where you have these clear levers for profitability improvement. Whereas for most of the others, I think the idiosyncratic ROA improvement story is non-existent. So that's what really makes us quite bullish on HDFC Bank at this point.
Pranav, you also look at some of the NBFCs lenders beyond the banks, some gold loan companies, some larger NBFCs. How are things looking over there? The regulatory glare seemed to be ebbing. In fact, that dip was completely bought in the gold loan side. Which are the names you're most bullish on there?
See, we are most bullish on Muthoot. I think the gold loan space is something we like within the NBFCs for a couple of reasons. One, we do see a long growth runway in the segment, just given the amount of gold ownership in the households, and more importantly, the uniform distribution amongst households, which means that these lenders can keep going deeper and deeper into the down the income pyramid. And second is, there is a very clear differentiation between an NBFC model versus a bank model, both in terms of the operating model, the target customers, the kind of products they provide, etc. Which means that this is one of the few segments where the risks of banks jumping in to provide exactly the same product is quite low. Now, I think the regulatory actions have largely been around operating practices rather than on the product itself. Unlike some of the others where you had an increase in risk weight or changes to the pricing or product offerings. Here, I think the regulatory action has been limited to a few players and also around well-established guidelines being flouted. Right? I think, therefore, we are quite bullish on the well-established players like Muthoot, who have been doing this for a long time and have managed regulatory expectations around operating practices.
Wanted to also get your take then on the regulatory impact on PPBL and what that could potentially mean for other players entering the space, what the long-term impact could be, because as per your note, you said as the dust settles, what is going to be the residual impact? So what do you believe that could potentially be?
See, I think our view here is that the risks for emerging product or a new product is a much higher, and the cycle seems to be a bit longer than what we have seen in the past, right? So I think almost every new product which has come in, be it microfinance, gold loans, consumer durables, all of them have gone through a bit of fine-tuning from the regulator. This time around, it seems to be a bit more stretched out. So we would be a bit more cautious on newer segments and more bullish on well-established models where the regulator has gotten comfortable over a long period of time.
All right, interesting to get in your takes, Pranav. Thank you so much for joining in and giving us a view on the private banks and financials as a whole.